The Federal Reserve faces a critical decision point in their ongoing cutting cycle. February employment data showing negative 92,000 payrolls, Iran war creating oil volatility, and institutional money positioned for continued rate cuts after the cycle that began in late 2025. But here's what Polymarket prediction odds and professional positioning reveal about the March meeting that most investors are missing completely. February's employment report delivered exactly the mixed signals that make Fed policy decisions impossible to predict. Payrolls dropped 92,000, but unemployment held steady at 4.4%. Wage growth remains elevated at 3.8% annually, still above the Fed's comfort zone despite previous cuts. Healthcare strikes distorted the headline number, while federal employment continues declining by 11% since peak. The labor market is cooling but not collapsing, creating perfect ambiguity for whether to continue the cutting cycle or pause. The Iran conflict introduces variables that complicate the Fed's ongoing accommodation strategy. Oil price volatility threatens both inflation control and economic growth simultaneously. Flight to safety flows into Treasuries create artificial demand for bonds, complicating monetary policy transmission. Supply chain disruptions from Middle Eastern shipping routes affect core goods inflation, but economic uncertainty weighs on business investment. The Fed must balance continued geopolitical accommodation against inflation persistence, and this calculation changes daily with conflict intensity. But here's what most analysis misses about Fed policy in 2026. The Treasury must refinance $8 to $10 trillion in maturing debt annually, with interest expenses still exceeding $1 trillion even after recent rate cuts. Election year politics creates enormous pressure for continued economic accommodation through further rate reductions. Congressional leaders from both parties privately lobby for aggressive cutting to reduce fiscal pressure, despite Fed independence rhetoric. This is fiscal dominance theory in practice, where debt levels effectively pressure continued monetary accommodation regardless of economic conditions. Polymarket prediction markets show 57% odds of another March rate cut, continuing the accommodation cycle that began in late 2025. But institutional positioning data reveals growing skepticism about sustainable further cuts. Professional money managers have reduced duration risk by 40% since February, suggesting they expect the cutting cycle to slow or pause soon. Bank lending standards continue tightening despite previous rate cuts. Credit spreads remain elevated across corporate bonds, indicating professional credit markets expect policy normalization ahead. Here's the positioning paradox that reveals how smart money really thinks about the Fed's cutting cycle despite political and fiscal pressures. Retail investors are buying long-duration Treasury bonds, betting on continued aggressive cuts driven by election year politics and debt refinancing needs. Institutional investors are shortening duration and increasing cash positions, recognizing that previous cuts haven't significantly improved credit conditions and further accommodation may create inflationary pressure. Hedge funds hold record short positions against 20-year Treasuries, betting that debt financing requirements will eventually force higher yields despite near-term cutting. Professional preparation for Fed meetings requires systematic monitoring of 4 indicators that reveal institutional sentiment more accurately than consensus forecasts about continued cutting. First, Treasury auction demand patterns, specifically bid-to-cover ratios showing real institutional appetite for duration risk despite recent rate declines. Second, bank stock performance relative to yield curve movements and expectations of further accommodation. Third, mortgage-backed securities spreads indicating whether previous cuts have improved housing finance conditions. Fourth, corporate credit availability measured by new issuance volumes and pricing spreads showing if accommodation is transmitting effectively. Fed communication strategy has evolved beyond simple rate guidance to managing cutting cycle pace expectations simultaneously. If they cut again, expect emphasis on data dependence and gradual pace rather than aggressive accommodation. If they pause the cutting cycle, expect language about monitoring previous cuts' economic impact and inflation developments. Professional money managers will focus on dot plot changes showing terminal rate expectations and pace guidance more than single meeting decisions about cycle continuation. The March Fed meeting represents a critical juncture in the cutting cycle that began in late 2025, complicated by unprecedented political and fiscal pressures during an election year. The key insight for institutional investors is preparing portfolio construction for cutting cycle volatility rather than predicting whether accommodation continues. Fed policy transmission mechanisms, through current market structure, remain fundamentally unpredictable even with ongoing rate cuts. Professional money management during ongoing cutting cycles requires scenario-based portfolio construction, systematic risk management across multiple pace outcomes, and avoiding concentrated directional bets on single Fed policy paths. The relationship between rate cuts, market pricing, and economic outcomes has become less predictable under current geopolitical and structural conditions. Subscribe to Premium Logic Lab for more institutional-level analysis that helps you position ahead of major policy decisions rather than reacting to them after markets have already moved.